The statement of financial position. In this session, we will look at the oldest of the three financial statements, the statement of financial position, commonly referred to as the balance sheet. The statement of financial position provides a summarized report about what a firm owns or is owed, what it owes, and the owner's interest at a specific moment in time. We will examine the structure of the statement of financial position, looking at how the assets are grouped into current assets and non-current assets, depending upon whether they are being held to be traded or will be used in the long-term operations of the firm. We will look at how the liabilities are grouped into current and non-current liabilities, depending upon the contractual due date of payment. We will look at the conditions that an asset must meet to be reported in the statement of financial position and the application of the going concern principle. We will also look at what equity represents and how it can be interpreted as being either the amount that the owners have invested in the firm or as the difference between what the firm owns and what it owes shows the value of their interest in the firm. We will also look at the accounting equation, which all transactions must follow when they are entered into the firm's financial records, and at some examples to illustrate its application. Session aims, in particular, is to learn about the statement of financial position, what it shows, its structure, what it is comprised of, the elements that make it up, and how it is presented. While we're going through this, we will start looking at some of the fundamental accounting concepts and principles that underpin financial accounting. For each session, there are a detailed set of intended learning outcomes, which I will not go through, but by the end of the session, students should be able to explain the following. I'm going to start by reviewing the three primary financial reports. The first and the oldest of the reports is the Statement of Financial Position, formerly known as the balance sheet. This is a statement of an entity's financial position, its wealth if you like, at a moment in time. We then have the income statement. This is a summarized statement showing income and expenses and profits of an entity, a firm, an organization, defined following a set of accounting standards and policies over a specified time period. Wealth, we talk about in terms of profit, is defined in terms of income and costs. And the final statement is the cash flow statement or statement of cash flows. This is a statement showing the cash inflows and outflows over a specified time period. Wealth here is defined in terms of changes in cash flows. And we can illustrate this graphically. The balance sheet snapshot as of a particular date, here the 31st of December 2016, and then the two periodic summary report, one of income and expenses, the other of cash inflows and outflows, resulting in a changed balance sheet at the end of that accounting period. Accounting periods are typically a quarter, half year or annual for public financial reports. We'll focus on the Statement of Financial Position. The Statement of Financial Position details a company's assets, what it owns and is owed, its liabilities, what it owes, and its equity, representing the claims of its owners. It is a statement of an entity's financial condition at a moment in time, and for that reason is often referred to as a snapshot. An entity might be a company, a partnership, an organization, or an individual trader. The published statement of financial position for public companies are usually as at the end of a financial year, a half year, or quarter. The statement of financial position has two equal but opposite sides. One side shows where the firm's funding has come from, and the other how these funds have deployed. We'll start on the asset side. The asset side shows details of what the firm owns and is owed, the firm's assets. Most of these assets are real, cash and physical assets such as property and equipment, but some assets are intangible. They have no physical form, such as intellectual property and mineral rights. Financial assets such as deposits held with banks and amounts owed to a firm by its customers do not have a physical form, but are treated from an accounting perspective in a similar way to cash. On the other side, we have liabilities. This is a slide showing where a firm's funding have come from, and here we have the details of a firm's financial liabilities. And it's used to record amounts owed by the business to other firms and individuals. These creditors include banks that have made loans to the firms and suppliers that have provided credit for goods the firm has bought and services that have been provided to it. And finally, we have equity, or owner's equity. This is the difference between assets and liabilities and represents the owner's claims, commonly referred to as equity and sometimes as share capital and reserve. The value of equity is given by the amount that owners have invested in the firm directly, plus profits that have been generated and retained in the business rather than being paid out as dividends to shareholders. The equity accounts are shown on the liability side of the statement of financial position. Let's look at some examples of assets and liabilities. We'll start with assets. Items owned by the company. Companies tend to hold most of their liquid funds as short-dated deposits with banks or in short-dated money market instruments such as commercial paper. These are collectively referred to as cash or as cash and cash equivalents. Stock, also known as inventory, very important asset at manufacturing companies, comprises raw materials, work in progress and finished goods, and is held by firms for the purposes of trading. Most firms also have investments in long-term operating assets such as land, offices, factories, machinery, trucks and automobiles, and these are collectively referred to as property, plant and equipment. Some of the most valuable assets at pharmaceutical and technology firms comes from intellectual property rights. Patents, royalties and licenses are examples of what are called intangible assets and under certain conditions may be reported in the statement of financial position. Lastly, firms may hold long-term financial investments in the form of part ownership of the shares or bonds of other firms. Also treated as assets are amounts owed by other companies to the company. These can include deposits that the company holds with banks, but also from customers for goods that the firm has sold them on credit and they have not yet paid for them, and for services that the firm has provided but have not yet been paid for. Amounts owed to the firm are also considered to be assets. When companies sell goods and services to customers on credit, the amount the customers owed is an especially important asset at companies whose customers are largely corporate rather than retail. Retail companies' sales tend to be on a cash basis. Let's move on to the liability side of the balance sheet. So liabilities owed by the company, probably the most important short term, is to suppliers for goods and raw materials that the firm has bought on credit and have not yet paid for, and to suppliers for services such as utility the firm has received but not yet paid for, and to employees for work done. Companies buy most of their goods and services from suppliers on credit, and the amounts owed to suppliers are an important source of short-term financing for many firms. Bank lending is an important source of long-term financing in some countries, for example, Germany, Japan and China. In the UK and the US, companies rely more on the bond market for long-term, typically 3 to 5 years funding, and more on that than on commercial banks. So liabilities includes banks, loans from banks, and interest on loans, and to bondholders for the principal on bonds, and coupon payments, effectively interest payments due on bonds issued by the firm. There are also amounts that are owed to the tax authorities for taxes which are owed but have not yet been paid. And finally, we have equity. The value of equity is given by the difference between what the firm owns, its assets, and the value of what it owes, its liabilities. The value for equity shows how much the interests of the firms are worth in accounting terms. This value is sometimes loosely referred to as book value. It has no direct relationship with the market value of the firm if listed, or the amount that would be left over if the firm was liquidated, all the assets were sold off, and all creditors, suppliers, banks, bondholders, tax authorities were paid off. And this is also equal to the value of the initial investment made by the owners, plus retained earnings, retained profits, less any payments made to the owners in the form of dividends. The accounting equation. All transactions must comply with the accounting equation when they're entered into the firm's financial records. This ensures that both sides of the statement of financial position must always balance. So assets equals liabilities plus equity. Total assets for a firm must equal the sum of its liabilities, what the firm owes to others, and the owner's equity, what the shareholders have put into and retained in the business. If we rearrange the accounting equation, we get the following. We can see that the value of equity can be calculated or expressed as the difference between the value of a firm's assets and that of its liabilities. This equivalence has an implication for the accounting treatment of all transactions. A transaction must always have entries on both sides of the statement of financial position for the accounting equation to be satisfied. It is this dual treatment of all transactions that lends itself to the name of double entry bookkeeping. Let's look at some examples of business transactions that illustrate the accounting equation at work. We'll start with two examples of companies buying raw materials, first with cash and then second with credit. So a company buys raw materials for £100 for cash. So what are going to be the accounting entries? Well, we're going to have an asset, in this case inventory, going up by £100. The assumption here is that if a company is buying raw materials, assume the price paid is a fair price. That being so, the value of the inventory will go up by the amount that's been paid, which is £100, and cash assets will go down by £100, which is the amount that's been paid out. So assets plus £100 for the inventory going up, minus £100 for the cash going out. Is fair price has been paid. There's no other transaction, no change in liabilities, no change in equity. The accounting equation balance 0 equals 0. Take the same example, but this time we will make the raw materials bought on credit. So we've got the same start. We've got inventory up by £100, so assets up by 100. But now, rather than cash being paid, the firm owes its suppliers £100 for the inventory that's been bought. So liabilities, the amount the firm owes the suppliers, is up by £100. There is no profit on this transaction. A fair price has been paid. So assets plus 100 equals liabilities plus 100 plus equity equals 0. Or equity of 0, I should have said. Let's take another example. A company selling finished goods that cost £120 to make, £480. And we'll do the first one with cash and the second one on credit. So a company sells finished goods, cost £120 to make £480 in cash. So the first thing we're going to do is we're going to receive the cash. So cash is up by £180. The inventory will be down by the amount that the inventory cost, and equity will be up by £60. The profit that's been made on the sale, the profit is the difference between how much it sold it for, £180, and how much it cost, £120. And our accounting equation, so assets plus 180 minus 120 equals plus 60 for equity and no change in liabilities. And we'll do the same transaction, but this time we will make it a credit transaction rather than cash. So the amount owed by customers, the asset, will be up by the £180 that is owed. The inventory will be down by £120, and we will still have a profit of £60, the difference between how much the agreed price of the sale and how much the goods that were sold cost to produce. And the accounting equation is basically the same as before. So asset, in this case, not cash, but an amount owed by the customer, up 180, less 120, which is the reduction in inventory, equals an increase in equity of £60. IFRS and other accounting standards divides both assets and liabilities into two major classes. Assets are classified largely based on intention into non-current assets such as property, plant and equipment that the firm intends to keep for the long term, and current assets, things that the firm intends to sell or consume in the near future. These include cash and financial assets that the firm is due to receive within 12 months of the date of the statement of financial position. Liabilities, sources of funds, are classified into equity, a form of perpetual funding provided by the owners of the firm. Non-current liabilities are the long-term financing, in this case debt financing, where payment is due more than 12 months into the future. And current liabilities, short-term debt and amounts owed to suppliers and other creditors and due to be paid within 12 months of the date of the statement of financial position. So that shows the sources of funds and how the funds have been invested. Current assets are assets that the company expects to sell or use up in the next 12 months and includes the following major categories. Inventory. Inventory comprises raw materials, work in progress and finished goods, and the cost of these are recorded in the inventory accounts. Inventory is also known as stock. Accounts receivable. The amounts owed to the firm by its customers are recorded in the accounts receivable accounts. And the third one we'll look at are cash and cash equivalents and other financial assets where the firm expects payment within 12 months are included here. Let's take a moment to look at the going concern principle. The going concern principle is that financial statements are normally prepared on the assumption that an entity is a going concern and will continue in operation for the foreseeable future. This principle justifies the use of historic cost accounting, where the value of assets recorded on the balance sheet reflects the cost of acquiring those assets rather than their current market or replacement value. Non-current assets are assets where the firm does not expect to sell, use up or dispose of in the next 12 months. The most important classes of non-current assets are property. Property comprises of land and buildings and also plant and equipment. And plant and equipment may include planes, trucks, automobiles, and also specialist equipment such as the petrochemical refinery. Under IFRS, firms are only permitted to recognise assets in the statement of financial position provided they meet the following requirements. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. Assets should be recognised on the balance sheet provided A, it is probable that any future economic benefit associated with the item will flow to the entity, and B, the item has a cost or value that can be measured with reliability. This latter condition leads to one of financial accounting's most important limitations. The statement of financial position excludes assets that will clearly give rise to a future benefit, but whose cost or value cannot be measured with reliability. Human resources. Where are the people? Many firms talk about their people being our most valuable asset, but slavery has largely been abolished. Firms do not own their own staff, even though it sometimes may feel like it, and we do not put a monetary value on their heads for accounting purposes. The value of many professional firms, marketing, media production, and some technology firms, for example, biotechnology and computing science, comes from their key personnel. If these people walk, the firm would have little remaining value. An exception might appear to be professional sports teams who buy and sell their star players. However, in law, terms are trading fixed-term contracts of employment rather than stars themselves. These contracts do appear on the owner's statement of financial position. The other thing which is missing, to a large extent, are intangible assets. IFRS requires firms to expense research and development costs and marketing expenditure. Firms are not generally permitted under IFRS to apply the historic cost principle to intangible assets. This means patents, new technologies, develop products and brands that are created by the firm itself through their own research or through their marketing activities do not appear in the statement of financial position. So they are present if bought or acquired from another firm, but generally absent if developed in-house. And this can include titles, mineral rights, broadcasting rights, software, patents, trademarks, copyright, and licenses. Liabilities. Liabilities, as was the case with assets, are grouped into two major classes. Current liabilities are due for payment within the next 12 months, and non-current liabilities, payments that are due 12 months or more into the future. Current liabilities, short-term in nature, obligations due for payment in the next 12 months include the following. Short-term borrowing, bank overdrafts, a form of expensive unarranged borrowing from short notice from banks. Accounts payable. Accounts payable is the account which is used to record the amounts that are owed to the firm's suppliers. This is for goods that the firm has bought and not yet paid for. Tax payable. Taxes that are due to the tax authorities and are payable within the next 12 months. And also a portion of non-current liabilities falling due within the next 12 months. So bonds and bank loans that are maturing will all appear under current liabilities. Non-current liabilities, all the firm's long-term obligations are included within non-current liabilities. These are amounts that are not due to be paid for more than 12 months after the date of record of the statement of financial position. Non-current liabilities are largely comprised of the following. Bonds that the firm has issued, and these bonds are issued to financial institutions such as fund managers and insurance companies, bank loans, long-term, medium-term loans from banks. Post-employment obligations are net liabilities associated with a firm's pension plans, and deferred tax, which are taxes that the firm owes, but where payment is not due in the next 12 months. Let's look at another principle, the business entity principle. A business is a separate legal person from its owners. What this means is that the financial statements concern the business only and not those of the firm's owners. It is also the case that a business can have rights and responsibilities which are very similar to that of an individual. So a business may enter into contracts on its own part. It may own assets on its own part, and it may have liabilities on its own part, which are separate legally from the owners of the business itself. Very important principle. So owner's equity. So owner's equity, this shows the interests of the owners in the firm, and we've looked how under the accounting equation we can arrive at equity as being the difference between assets less liabilities. It comprises share capital and share premium. These accounts represent new money that investors have put into the firm. Retained earnings represents profits that the business has made and that have been retained in the business rather than being paid out as dividends, and certain other reserves which we'll look at in due course. Let's look at examples of a different presentation form. This is the vertical presentation form, and it's a common form in the USA. Balance sheet as of a particular date, here the 31st of December 2017, and the values are in millions of dollars. In the US, it is convention to put current assets first and then non-current assets, so from most liquid to least liquid. So current assets, non-current assets, total assets, and then we have current liabilities listed in terms of maturity. So current liabilities and non-current liabilities, total liabilities is 6,000, and owner's equity of the difference between assets and liabilities of 8,000. Total liabilities and equity is 14,000. This is my preferred form. It is the simplest and it is the easiest to understand. Morrison's statement of financial position in the vertical form, and this is for as of 29th January 2017. Morrison is a UK retailer, and in the UK it's common to present non-current assets first, followed by current assets. IFRS does not have detailed presentation standards, and either presentation form would be allowed under IFRS. So we start off with non-current assets. In 2017, non-current assets of £8,070,000,000, current assets of £1,176,000,000, total assets of £9,246,000,000, and this is funded with current liabilities of £2,864,000,000, non-current liabilities, in fact smaller than current liabilities, of £2,390,000,000, total liabilities £5,183,000,000, and the difference is owner's equity of £4,063,000,000, total liabilities and equity balancing of £9,246,000,000. The notes of the financial statements are really important supplementary information, and they detail things such as the accounting policies and estimates that have been used in the preparation of the financial reports. There are various qualitative disclosures. They may include explanations for what an item that's been reported comprises. For example, the types of properties that a firm owns, or if in the income statement, the major sources of other income. They may also explain some of the reasons behind changes in the value of items from one year to the next. They give greater granularity, so we can go from assets to current assets and non-current assets. Those current assets and those non-current assets can be broken down into much more detail. And that breakdown of accounts gives more detail, for example, property, plant and equipment, than given in the summary balance sheet. So in this session, we've looked at what the statement of financial position shows, is comprised of, and is presented, and some of the fundamental principles that financial accounting is built on.